Options Trading for Beginners, the ultimate in-depth guide.
Most important concepts to understand in options trading is what we call extrinsic value decay or time decay. As I've just described, options with more time until expiration will trade with more extrinsic value or time value. And I also said that options that are expiring very soon will not be trading with significant levels of extrinsic value or time value because there's not a lot of time left for the stock price to move, and therefore there's not a lot of time left for the option to become intrinsically valuable.
Okay, so I've been calling extrinsic value and intrinsic value different names. Intrinsic value, that's the moneyness. That is how much it's worth, right? That's how deep in the money it's gone. That is the moneyness. That is what we're looking to maximize. Extrinsic value is our uncertainty value, right? We want to know, we want basically the most amount of moneyness with the least amount of uncertainty. And at expiration, the extrinsic value goes to zero on every option, on every strike, on every expiration, every time. No matter what, extrinsic value always goes to zero. You understand that? Moneyness, the intrinsic value, will be determined by how deep in the money it is, how far it has gone into the money with our option strikes, how far the current price is compared to our option strikes. That's how much moneyness we have. Now, the extrinsic value, I like to call uncertainty value, because as you go out in time, that uncertainty value rises, right? We don't know what's going to happen further out in time. 6 months from now, we know a lot less than we do 6 days from now. So our uncertainty premium is going to be super high. We understand that, right? We can all say that the further out in time we go, the more uncertainty there is. That is a general principle nobody can argue with. So we want to make sure that whenever we're putting on a trade, we minimize how much we pay in that extrinsic value. So I've actually interviewed Chris Butler here on the channel before. You're welcome to find it in my YouTube archives. And that was at a point in time where I and he were both selling options. I don't know if he has changed his stance, so I don't know where he's going to go with this, because when you're an option seller, all you're trying to do is sell extrinsic value. And the issue with selling extrinsic value is it ticks down one day at a time, right? It ticks down over time. Let me show you what I mean by that. It ticks down over time, extrinsic value does. And as an options buyer, we want to pay as little extrinsic value as possible, because it does tick down over time. And when you buy deep in the money options, you can see that it has a linear decay each day, because each day we get more and more certain, right? Each day the uncertainty value gets smaller and smaller and smaller. But if you're buying out of the money options, it's going to start here and it's going to decay, and then it's going to pick up speed and ramp up significantly towards the end. It's still going to go to zero. They're both going to go to the same place. But if you're buying the out of the money option, you have significantly more of your investment tied up in what is decaying on a daily basis, 100% of it, versus only 13%, 15, 20% is basically my wheelhouse, 20% or less will decay over time. So 100% of yours, because you're buying out of the money, only, let's say in this example, since I wrote it down, 13% of mine is going to decay. Now, the other issue is that as it goes on, if you are selling the options, you have to have days pass. You cannot be paid. You will not get paid if you sold the option and you're trying to collect the extrinsic value. You must have time pass. You are locked into the trade until time has passed. That is the insidious nature of selling options. You are so screwed, because all you can do is sit there and hope and pray that this is going to work. Whereas if you're buying the deep in the money options, you can look at it. You can say, okay, is this working? Yes, cool. I'm going to let it work. I know I'm going to have some time decay, but that's fine. My movement in the option price is going to more than make up for the small amount of time decay. And if I'm wrong, I get out of the way. If you are the option seller, you have to sit and wait, if you're right or if you're wrong, for days to pass. For days to pass. But you know what? Somebody asked a really good question. I skipped the intro. Who is this random guy on the internet? Dude, I'm so glad you asked. I may be a random guy on the internet, but my name is Christopher Ewell. I've twice been awarded Top 100 People in Finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And that was a fantastic question. Thank you for that. Let's get back over here. I want to continue on with this, and I'll interject as I see from practical history to the theory of the options that he's trying to teach here.
Look at some real examples, as I like to do in this video. Let's look at some Apple call options, and we'll look at a call option with the same exact strike price, but in different expiration cycles, and we'll compare the values of those options. In the exact moment that I took this screenshot, Apple shares were currently trading for $304.92. And I have opened up a couple different expirations so that we can compare the option prices. So let's focus on the call options with the strike prices of $305. And since the stock price is below...
Okay, great point here. So as he's looking, right, I don't know the date that he recorded this. It's obviously been a while. And, you know, on the beginning part of this video, if you don't watch the live streams, you miss out. I talked a lot about my time working with Larry Hite in the live stream. So if you're missing the live streams, you're missing out, because you're probably watching the replay at this point. Statistically speaking, you're watching the replay. But looking at this, I have no idea when he recorded this, but these are timeless principles. And that's what I want to get across, just like in the Market Wizards book. This was in May 2020 with 1 day to expiration. This was in June 2020 with 36 days to expiration. This is in January 2021 with 246 days to expiration. And that extrinsic value, which there's not a column for it shown on here, but you can do the math, and I can show you the math in a minute if he doesn't. But that extrinsic value is going to grow for each one of these. In fact, look at this, right? The 305 strike right here is $3.10. The 305 strike right here is $13, right? The same strike, but 35 days longer costs $10 more. And then you go out in time to 246 days, that same strike is now $34. So it's 10 times higher to go 246 days versus 1 day because there is significantly more uncertainty. Does everybody understand? Let me know in the chat. Type the word I'm certain. Type the word certain, CERTAIN, if you are certain that you understand that the further out in time we go, there's additional uncertainty. So you have to pay a premium for that additional uncertainty. Okay, let's keep going here.
$305. These call options have 100% extrinsic value. So since they don't have any intrinsic value because the stock price is below the strike price, the prices of these options are entirely extrinsic, meaning that they are entirely associated with the time left until expiration and for the possibility that Apple could make a big movement over those specific time periods. As we can see, the call option with a strike price of $305 in the January 2021 expiration cycle is trading for $34, meaning that the cost or premium of that call option is $3,400.
Which is huge. That is giant. Now, one thing I just picked up when he was talking, these are actually out of the money. What does out of the money mean? The current price of Apple, I know it's a little bit hard to see with the YouTube title up there, but the current price of Apple at this time was $304.92. If it were to expire today, remember, all options have an expiration date. If it were to expire today, every single one of these is worthless. And let me just reiterate the point of what worthless means. Right? I didn't conceptualize it for a long time. Worthless means it has no value whatsoever, meaning that this quarter from 1990 has more value than that option that you just bought that's out of the money at expiration. That's how worthless it is. I didn't understand that for a long time. Worthless, not worth less, worthless. This is not like stock trading where you know, if the price of the stock goes down up 1%, you still have 99% of it. No. It's worthless. Okay. So going back to this, right? We've got 3 different strikes. All of these are out of the money. Every bit of these has no moneyness at all. All of it, not one monkey donkey penny. Exactly. It goes poof. Yes. Now, all of this has 100% extrinsic value. All of this is that uncertainty value we talked about earlier. I do want to reply to this person. Apologies, Eminem. I can't read the rest of the name, but I want you guys to know I never want you to feel like you need to send me a super chat. I do this for free because I love it. So please don't ever feel obligated to send me a super chat. There is a channel that I do watch to get some YouTube tips, and he only talks to people who super chats him, and it's just so dirty, so scummy. And I don't want you guys to ever have that opinion about me. I love you. I love doing this, and I love helping you out because this is my favorite game in the world. So never feel like you need to send me a super chat. But since you did, let's talk about it. Hello, Chris from Israel. How to use OVTLYR 9 for crypto or Bitcoin? Dude, that's going to be tough, right? We're going to switch gears slightly because Eminem paid for it. But the OVTLYR 9 is this here, right? So it's 40% due to the market, the trend, the signal, and the breadth. This is what we want to see the market showing in our direction. Next, the sector, the fear and greed, and the breadth. And the stock, the trend, the signal, the fear and greed, and OVTLYR blocks on its own. Now, first, to answer the question, we don't cover crypto just yet. Crypto is on our roadmap. I can't tell you when it's coming because I honestly don't know, but crypto is on our roadmap. So let's break this down. How would you use OVTLYR 9 for Bitcoin or crypto? What I would start doing is figuring out what the what would you consider like a trend for the market of crypto? It may be Bitcoin itself, I don't know. But if there's some sort of like crypto ETF that covers, multiple cryptos, that would be a good place to start. I don't know that answer, but could be a great place to start. Then what you'd want to do is look into all the components of that and say, okay, if I were looking at these, are they showing to be bullish right now with the 10/20 price over 50? If you can see at least half of them to be bullish with the 10/20 price over 50, then you could consider the breadth to be over 50%. So, and this is difficult, right? Because I don't have the answers to you on this, but I'm trying my best. Then the sector. Then I would start looking at the ones that are similar to Bitcoin. I don't know what those are, but imagine that there's a handful of ones that are similar to Bitcoin, maybe like Ethereum. I don't know the other names. And see if they are moving up as well, right? If they are moving up, right? Basically, what you want to do is you want to find similar assets that are moving together, right? Similar assets that are moving together. And then once you have that, break that down onto that one stock, because a rising tide lifts all ships, right? And even though we don't have the crypto data, we can still get an idea of what is happening in that sector, right? And that sector being the crypto sector. And then break it down to that one individual stock, in this case, Bitcoin, and say, okay, what is Bitcoin doing? Is it trending higher? Okay, maybe that'll work for me. So unfortunately, I don't have that. I'd love to help you out with that at some point in the future. So be sure to come back, Eminem. All right, let's get back over here onto options.
So this option has 246 days until expiration. And since there's 246 days left until expiration and the stock price is already right at the option strike price, with over 200 days left until the option expires, there is plenty of time for Apple to make a big stock price movement, particularly to the upside, which could leave this option with significant intrinsic value. So the reason that this 246-day call option is worth over $3,000 is because Apple can make a pretty large move in the stock price over a 250-day period.
Right. The uncertainty value is cranked up to max. The uncertainty value is off the charts because it's 246 days versus just a couple days,
as compared to a one-day period. So the option prices will reflect this. If we look at the 305 call option in the May expiration cycle, this option expires in 1 day. And the cost or premium of that option is $307, which is the price of 307 times 100. So if we compare the 1-day 305 call to the 246-day 305 call, we can see that the 246-day call is about 10 times more expensive than the 1-day 305 call. And that's because with 245 more days until expiration, there is a greater potential value in the 305 call expiring in 246 days as compared to the 305 call expiring in 1 day. So the reason that the 1-day call option with a strike price of 305 is only worth 307 is because Apple's not going to make a $100 movement in the stock price over the next 1 day. But over the next 246 days, that is a much higher probability of actually occurring. So the reason that a longer term option will trade with more extrinsic value or time value is because there's a lot more time left for the stock price to move. And because of that, there's a lot more time left for the option to become intrinsically valuable. So if we can imagine that I buy that 246-day call option for $3,400 and hold it until it only has 1 day left until expiration, and Apple is still right at 304.92.
I would bet you that his chart right here is about to look a lot like this chart. I have not seen this, but I bet it's going to look a hell of a lot like this. Let's see.
then we could think that I would lose about $3,100 on that position. And that's because if I buy a call option with 250 days to expiration, that is 100% extrinsic value.
Huh, how about that? So this is the price of the extrinsic value going down over time. The price of the extrinsic value going to zero. Because remember, all options on every strike, on every expiration, every stock, doesn't matter. All of them have the expiration go to zero. And this, because it was an out of the money option, is exactly what will happen.
And I pay $3,400 for that option. But with 1 day to expiration, that same option is worth $300. Well, I will lose $3,100 on that trade simply from the passage of time. And that is called extrinsic value decay or time decay. So that just means that as time is passing and as an option approaches its expiration date, it will trade with less and less extrinsic value because its final valuation is becoming more certain. And what I mean by that is if an option has 10 minutes left until expiration and it has $0 of intrinsic value, there's a good chance that in the next 10 minutes, the option is not going to be worth anything. And because of that, it's going to be trading with very, very little extrinsic value. But if that same option had 10 days to expiration, then it would probably be trading with a lot more extrinsic value because there's a lot more time left for a stock price movement to occur that could leave the option with intrinsic value. So in the sections of buying call options and buying put options, I had stated that when you buy a call option or you buy a put option and the stock price does not move, you will lose money. And the reason you will lose money is because if you buy a call option or buy a put option, that option is going to have some extrinsic value or time value in it, especially if you are buying an option that is not in the money or has intrinsic value. And because of that, as time passes, the extrinsic value will come out of that option, leading to a lower overall option price. And if you buy something and its price falls, you will lose money. So
Okay. So totally agree with everything that I said. There is no doubt about what he said whatsoever. Just remember, extrinsic value always goes to zero, right? Doesn't matter if you love the stock, extrinsic value will always go to zero. Now, here's the other thing, right? If we pop this open and look at an options chain right now, it's unavoidable. It is unavoidable. You cannot go around and say, you know what, that's fine. I'll just buy options with no extrinsic value. That is an unavoidable thing. This is the cost of working with the leverage of options, okay? You're not going to get a free ride in this market. There is no free lunch. There are no free options, okay? If you're going to buy an option, there will be cost associated with that. And that cost will go down over time. But you determine which option that is. You determine how much you pay for it. And you determine how long you hold it for the option to work against you, okay? But whenever the stock is moving, that extrinsic value, I don't care about it. I don't care about it at all. I see a lot of people asking about, what about theta decay? I don't care. Delta moves, the movement of the price of the stock is significantly higher than the theta move. Theta is that time decay that we're talking about here. Theta is this that's happening every single day. The delta move is for every $1 move in the underlying stock is how much the option price changes in value. Let me see, can I add a column for grid orientation, grid format, strikes? Yeah, I'm sure that there's a set. I forget where the settings are at on this. I was going to see if I could add theta on here because the theta is going to be significantly smaller than the delta. Hold tight. I'm going to need to pop you off my screen real quick, see if I can add that in. Option grid. Oh yeah, for sure. Hold on. Here we go. This is my, okay, we're good. I'm not sharing anything I didn't want to share. Theta, let's add that. And hit exit. Did that work? That did not work. Let's try that one more time. Sorry. Because the reason that I'm doing this is people really make a big deal about how much theta is in an option. And I am the exact opposite. I really don't care. Maybe save layout. Oh, there it goes. Okay, now we got it. Okay, so theta right here. Theta is smaller than delta, right? Now it still looks pretty big, but this probably should be in like a decimal point, right? Because every day or every dollar that the stock moves, there will be some theta decay, but it ain't gonna be that much. There might be like 0.63, right? Not 63% or anything like that. So your delta will always be bigger than your theta. This is the number I care about because that's where I'm going to get paid. This is the number I don't care about because it's so small, it doesn't make a difference in the way that I trade. Okay. Sleven asks, what happens when the extrinsic value starts in the negative? Extrinsic value starts in the negative? That's super unlikely. That's probably just a math. I wouldn't call it a glitch, but more of a rounding error inside your platform. Trust me, no market maker is going to sell you an option that has no extrinsic value. Not going to happen. Okay, let's go back to the video here.
In the next sections, we're going to cover the other two options trades that you can potentially make or that will make up other strategies that you'll learn about in the future. And these strategies will actually make money when the option prices are decreasing from the passage of time and from the decrease in the extrinsic value of the options. So the next two strategies that we're going to learn, which are completely opposite of the first two that we learned, will actually benefit from.
We will not cover selling options. Selling options is the most dangerous thing you can do in trading. So I'm not even going to entertain what that means. Okay, we're going to skip through this. Thoughts on short put example. I mean, if you really want to learn about the worst, most dangerous strategy in the world, by all means, go watch this video on your own. I'm not taking you down that rabbit hole. No way. No way. Let's go here.
And why that makes sense. But now we need to discuss something called implied volatility, which you should not be intimidated by this term because I'm going to explain it to you very clearly in just a second. But implied volatility concerns itself with option prices, particularly how we can look at two different stocks and understand why their option prices are different and understand a metric called implied volatility that essentially nicely summarizes to us how the two options on these stocks compare. So do not be intimidated by the word implied volatility, but it's a very important topic because we need to further understand option prices. The first step in understanding option prices was talking about intrinsic value and extrinsic value, but now we need to talk about implied volatility. So do not be intimidated by the words implied volatility. If we use different words to swap out implied and volatility.
I don't know what he's going to say, but I'm going to say this is expected moves, right? If people are excited about a stock and they expect more movement, be up or down, then the implied volatility will grow, right? And so this really happens a lot around earnings, right? Because at earnings, we understand that there is a lot of uncertainty. We do not know what's going to happen after earnings, but we do know something's going to happen. It could be good, it could be bad, or really it might not do anything, but something's going to happen. And because of that, the implied volatility reaches a very high level. Right after earnings, though, that gets crushed. Right after earnings, we can see what's going to happen. So that implied volatility goes, almost down to zero, or at least a level that is more normal for that stock.
We would get expected magnitude of stock price fluctuations. So we could
go stock price fluctuations, like I was just saying.
We could swap out implied for expected, and we could swap out volatility for magnitude of stock price fluctuations or changes. So implied volatility is essentially the market's expected magnitude of a stock's price changes in the future. And what is the market, or how is the market telling us that it is expecting these stock price fluctuations? Or what is implying the level or magnitude of these stock price fluctuations? Well, it's the stock's option prices. Let's look at two similarly priced stocks because options are somewhat a function of the stock price, because a 10% move in a $100 stock is $10, but a 10% move in a $1,000 stock is $100. And because of that, the option prices on two different price stocks will be drastically different simply because they are different priced stocks. So let's go ahead and look at two similarly priced stocks and look at the option.
I'm actually super, so I want to look at like a today value of these two stocks and see what's changed since then, since this was made in 2020.
In those stocks with the same strike price and the same amount of time until expiration, and see what we find. The first stock that we were going to look at is Visa with the ticker symbol
V. Ticker symbol V. All right, so today it's around 350. 350. Wonder what it is in 2020.
V. And as of this image, Visa
179. So it's doubled in 5 years, basically.
Shares were trading around $179. So let's go to the June expiration cycle in Visa's options. In the June expiration cycle, which had 36 days until expiration, the 180 call option, or the call option with a strike price of 180, was trading for $7.35. Now keep in mind, since the call option strike price is above the current stock price, we are looking at an out of the money call. And that means this $7.35 price we are seeing is 100% extrinsic value or time value. And also, I just said that the option was out of the money, but I also mentioned that options with strike prices near the stock price are referred to as at the money. So you could say this is an at the money call option in Visa, since the stock price is 179 and we are looking at a call option with a strike price of 180. But since the call option is only extrinsic value, it is technically out of the money as well. So this is our first stock.
Let's clear that up slightly. At the money can be really 2 to 3 different ones, or really 3 different ones. It could be the one right above, the one like right at, and the one right below it, right? It honestly could be any one of these 3. It really is the closest to the current price. So 608, 608. And now in a couple of minutes, if this bounces up to 609, it'll be the 609. Okay, so when it's at the money, it really is these 3 strikes right here. Just want to give my 2 cents.
In our comparison. Our second stock that we are going to look at is Teladoc Health, which has the ticker symbol TDOC.
Ooh, I bet this looks a lot worse than it did, right? So Visa doubled. I wonder what's happened to Teladoc. I can bet you it ain't good. TDOC. $8 stock. What was it in 2020?
So as of this image, Teladoc shares were also trading.
Oh, 178. Yeah. Yeah. The time has not been kind to Teladoc. Yeah. Right. So a lot of people ask me, why do I focus on stocks that are over $20? This is a good example, right? Nobody wants this stock. Nobody wants an $8 stock, right? Maybe in 2020 when it was $178, but today an $8 stock, nobody wants this. This is not a good stock. The perfect example.
Trading around $180. So just like we do with Visa, let's go to the June expiration cycle with 36 days to expiration and look at the price of the 180 call. So the call option with a strike price of $180 expiring in June, which is 36 days away. As we can see here, the 180 call option in Teladoc that expires in June is trading for $15.45. And as we just saw in Visa, which was trading for essentially the same stock price and has a June expiration cycle with options that have the same amount of time until expiration as the ones we are looking at in Teladoc, that 180 call option was trading for $7.35. But in Teladoc, the 180 call option with the same amount of time until expiration is trading for $15.45. So the call option in Teladoc with the same strike price and time to expiration as the Visa call option that we looked at is trading for twice as much. So the extrinsic value in this call option is twice that of the call in Visa. So if I wanted to buy one of the Visa call options, I would need to pay $735 in premium. But for the 180 call option in Teladoc, with the same amount of time until expiration, I would need to pay $1,545 for one contract. So why is this? We would say that Teladoc has.
And so when you see me trade options and I say, ooh, that's really expensive, this is what we're looking at here, right? Like the same price of that stock costing twice as much basically for an equivalent option. Like that's and you'll get a hang of that as you trade more and more. You can pop into something and be like, woof, how much is that? That's really pricey. I don't even look at any Greeks or any other numbers to know like, oh, that is an expensive option.
Has higher implied volatility than Visa. And what that means in plain English is that the market is expecting larger stock price changes over the next 36 days in Teladoc shares as compared to Visa. And how do we know that? We know that because the option prices in Teladoc are twice as expensive as the options in Visa. And as we have discussed earlier, time value is associated with the option becoming intrinsically valuable or significantly intrinsically valuable before it expires. So the fact that the 180 call option in Visa is trading for $7.35, but the Teladoc 180 call option is worth $15.45, and both of these call options have the same amount of time until expiration, this tells us that the market thinks that Teladoc shares could increase significantly more as compared to Visa.
I'm glad he added that. Or decrease, which is what we saw. But the movement is the expected movement is what we're looking at here.
The shares in the same amount of time. And this is called implied volatility, which again is the market's expected magnitude of stock price movements in the future. So since Teladoc's options are twice as expensive as the ones in Visa, we know that the market is expecting much larger stock price fluctuations in Teladoc shares as compared to Visa. But why would the market think this? To understand why this could be the case in Visa and Teladoc, let's look at the volatility or the daily price ranges of Teladoc shares and Visa shares over the same period of time. So what I'm going to do is I'm going to
now there is a indicator that I like to use called ATR. So it's down here at the bottom. ATR measures how big these movements are. ATR could equivalent really well with implied volatility, but not necessarily, right? Not necessarily. So for example, earnings happen here, and I know earnings cause the implied volatility of the options to expand. However, you can see the ATR going down in value. So the candles, the daily movement here, which is what ATR is measuring, is actually getting smaller. But the implied volatility is going to increase because even though the candles are mathematically, historically getting smaller, there's still a potential for an outsized move. So the implied volatility and ATR don't necessarily correlate one for one. Look, we are getting so deep in this.
plot the high to low stock price range in Teladoc and then the high to low stock price range in Visa every single trading day over the past few weeks. And we are going to look at the basic stock price ranges for these stocks over the same period of time to see if we can learn something about the volatility that has historically been observed in these stock prices. As we can see in this visualization, the high to low range in Teladoc shares has been significantly higher on every single trading day as compared to Visa shares. For example, on May 14th, the high to low stock price range in Visa, meaning the highest price of the shares subtracting the lowest price of the shares on that trading day, was somewhere around $6. So Visa shares traded in a $6 range.
Yeah, Rick, exactly. ATR tells you about recent volatility. Implied volatility tells you what the market thinks of future volatility would be. Well said, Rick. Everybody pay respects to Rick in the chat, Rick. Everybody pay respects to Rick in the chat. Really appreciate you, dude, on that.
On May 14th. But if we look at
ATR can apply to stocks and options. I mean, it is the movement of the stock price itself. So ATR works for stocks for sure. Ricky Bobby.
the high to low range seen in Teladoc shares, we can see that the high to low range was somewhere around $13 to $14. So the stock price range in Teladoc on May 14th was twice the magnitude or twice the range as the daily range seen in Visa shares on that same day. That is a measure of stock price volatility, how much the stock price has moved on a trading day. Now, I'm not saying that the option prices are looking at this chart and they are saying we need to pay twice as much for Teladoc options as compared to Visa options, but I decided to make this visualization to cleanly describe why the options on Teladoc are much more expensive than the options on Visa. And very simply, it's because the observed volatility in Teladoc shares has been significantly higher than the observed volatility or stock price changes that were seen in Visa over the same time period. All right, so implied volatility is the market's expected magnitude of stock price fluctuations. And what is implying the magnitude or expected magnitude of the stock price fluctuations in the future? It is the option prices. So in the options world, when you look at two similarly priced stocks and one has significantly more expensive option prices than another stock that has the similar share price, then the one with more expensive options has higher implied volatility. And that just means that the stock market or the market is expecting that stock to experience much larger stock price swings compared to a stock with lower levels of implied volatility. And typically, that implied volatility will be directly tied to the observed volatility in that stock. As we just saw in Visa and Teladoc over the past few weeks, Teladoc shares have seen much larger daily ranges in the stock price as compared to Visa, and they are...
Which plays into the average true range, the ATR that we were just talking about right there.
Similarly priced stocks. So because of that, the option market or option buyers are willing to pay higher premiums for Teladoc options as compared to Visa. And also option sellers or people that are shorting options are demanding higher premiums to take the risk of shorting options on the higher volatility stock, which is Teladoc. So anytime you see two similarly priced stocks and one has significantly higher option prices, it's because that stock is probably a lot more volatile and the market, particularly options traders, are willing to pay much higher premiums for those options because since the stock price is moving around a lot more, those options have the ability or the potential to become significantly intrinsically valuable before they expire. So that is just a very high level.
There you go. That was, I love these options deep dives. I hope you do as well. We are learning an absolute ton. There was a couple of questions in the chat that I wanted to answer real quick. Eric says, how much is OVTLYR? And then AK says, OVTLYR costs you just 85 cents a day. Actually, To answer the question here, OVTLYR is just 82 cents a day if you get the annual pass. But listen, only go get the annual pass if you're ready to save time, make money, and start winning with less risk in 3 easy steps. Step 1, head over to OVTLYR, grab the annual pass for just 82 cents a day. That's 64% off the regular monthly price. Or you can upgrade with 1 click and save 64%. Step 2, start using the OVTLYR 9 framework to know if everything is set up for your stock. And step 3 is sit back and relax because you just found the easiest way to save time, make money, and start winning with less risk. Hey, don't forget, we will be putting on trades today. I'm really excited to see you this afternoon. But in the meantime, if you're ready to save time, make money, and start winning with less risk, you should probably click one of these 2 videos. We'll talk soon.